Merry Christmas, everyone. Thank you very much for joining us for another market update. Once again, we have the privilege of having David Bassanese, the head economist of BetaShares. He has a master's from Harvard University, and he's a local Adelaide boy.
Yes, great to be in Adelaide, close to Christmas too. Good to be here.
I mean, hopefully you don't get trapped here, but...
No.
But it looks like this year Santa has brought us a lovely gift of a new variant of COVID, wrapped in a lovely bow tie of inflation. So very much an interesting time where, we thought we were going to have this fantastic bull run to Christmas.
Yeah.
We're just having a couple of little hiccups.
Sure.
So we'll see what the next few months have in store for us. But interestingly enough, it looks like potentially there's been a lot of naughty boys and girls in China, because we've seen a shipment of Australian coal go through the Chinese ports. So maybe they wanted that because they're having a bit of an energy crisis over there, right? So
that's right. I mean, they I think at the end of the day, they realise they need our coal, right? Because it's important for many cities for their electricity. So much as they probably don't want it, they would like not to have to use it, but they do need it.
David, so I think there's been a lot of speculation around what Omicron and what interest rates rising in the Fed in the US might do. What's your views on 2022?
Look, I think the biggest challenge for the market next year will be the fact that I think the US Federal Reserve, as you mentioned, it does look like it's going to be raising interest rates, and the economy in the US is running very strongly. It does have lingering supply chain problems. Basically, you've got demand running ahead of supply. And that's creating some inflation pressure, goods shortages. And I think the Fed now is saying, well, we need to, just to make sure we run, demand doesn't run too strongly. And we do want to see inflation come back down again next year. To ensure that happens, they're going to raise rates. Equity markets are trading at highish valuation, so that's going to be a headwind for the market, not necessarily a brick wall. Because at the same time, the economy is strong and earnings are quite strong. So it's going to be this push-pull, interest rates going up, putting downward pressure on valuations, but earnings still coming through. So you're looking at, still positive, but probably moderate, more moderate gains in the markets that we've, I guess, enjoyed since the bottom since COVID of early 2020. But that'll be the biggest challenge, I think, is, the market's negotiating the Fed, raising interest rates. In terms of the variants, I mean, I think we'll see with Omicron, but I mean, I think what we're seeing is that, yes, these variants are going to be with us, and they're going to be highly transmissible, and they may evade the vaccines. But what ultimately matters for the economy is, do governments need to go into lockdown? And what ultimately matters on that is, are the symptoms of the variant serious enough to cause hospitalisation and death rates? And look, early days with the new variant, but it seems that it may not be that the symptoms may not be any worse than what we've seen in the past, maybe even be more milder. And if that's the case, we'll be learning to live with the variant. And as more variants emerge, provided the severity of the symptoms aren't too bad, yes, it's going to be something we just sort of learn to live with.
Mm-hmm. Yeah, it was interesting timing with Jay Powell coming out and saying, all inflation, we're in deep trouble here.
Yeah.
And then the Omicron thing happened at the same time.
Yes.
Do you think it's more of a supply side or a demand side issue that we're going to face going forward?
Well, I think look, the COVID itself was a supply, what we call in economics, a negative supply shock. So it actually reduced supply capacity of the economy because we had to shut down shops and factories and whatnot. And it was also a demand shock because people lost their jobs. And central banks initially focused on restoring demand, even though supply was crippled. So the combination of boosting demand while supply was crippled caused all this inflation that we're seeing, particularly in the US. So, yes, there is a supply problem, but it's a supply problem because demand has run ahead of supply. And so what they need to do now is just accept that supply is hampered and it's going to take a while to recover. And demand can't run ahead of supply in the way that it has done. And we need to make sure it comes back into line, or at least give supply a chance to catch up. And so that's why central banks, I think now, particularly the Fed, are looking to raise rates just to take the edge off the economy. Because at the moment, the outlook for the US demand side of the economy is still very, very strong. Recovering from COVID, businesses have got a lot of inventories to rebuild up. They've run down their inventories. Consumers are cashed up. The household savings rate in Australia and in the US is quite high. So there's a lot of spending power still to come through into the economy, which if the supply side's not ready, we've seen what can happen. You can get inflation picking up.
You can't print money to fix supply side issues. But,
no, exactly.
It's interesting in the last few months we've seen very strong corporate earnings from the US, and that's obviously bolstered the indexes. But generally speaking, as we go into a rising interest rate environment, that is quite, it causes volatility.
Yeah.
Are you worried about a bit of a correction coming forward with the Fed and the RBA saying 2023-ish?
Yeah, look, I think, if you probabilistically, you may get a correction in the equity market of the order of 10% next year at some point. So net, you may get still, moderate positive returns, but doesn't deny the fact you may get a correction as the reality of the Fed raising interest rates, dawns on the market. I mean, Powell's only just hinted at the moment, but if he follows through, there will be a period where the Fed is raising rates, and that's going to cause a lot of nervousness. So historically, I've looked at this. Historically, the Fed raising rates coming out of a recession, as they did have last year, more often than not leads to a correction in the markets. Not all the time. More often than not, it does. So probabilistically, you'd say yes, maybe a 10% correction in the market at some point through 22 is more likely than not.
Yeah, I mean, we might see a 6% rise up to that point. And
that's
then
right.
Back. I mean,
and then a rebound,
that's right. So it's just like the housing market. As much as maybe the housing market backs off, we're still probably net ahead.
And the point I would make, I think about the periods to be most worried about equity markets, like the big bad bear markets, as they call them, 20 to 50% declines, as we saw during the GFC and the dot-com bubble 20 odd years ago. That's when the US goes into a sustained recession of more than a year. And I think that risk is still some ways away. You need to get we're still in the early to mid, well, maybe not early, but at least mid-stage of a new cycle. We're not at a late stage of the cycle. And so that's still some ways away. So what we're talking about is a correction within an ongoing expansion and an ongoing bull market.
So specifically for our market, the ASX, we're seeing China slow down a little bit. Their PMIs are kind of sort of floating and stalling. Yeah. But they've been talking about stimulus. They're going to stimulate small to medium and all this stuff. Yeah. Iron ore, obviously, we're seeing a bit of coal come through, which is usually something to do with steel production as well. Yeah. Do you think the Australian market's going to be strong the next 12 months?
Look, I think my view, and I know it's not great news, but for investors from a total return perspective, is our markets tended to underperform globally in recent years, and
that's mostly because overseas they have more tech and.
Yeah, and look, what's been driving markets for really in the years since the GFC has been the global tech boom. And Australia, although we have technology companies and great technology companies, is a small part of our market. What dominates our market are the banks and the resources, and they've had their own challenges. And I think both of those are still going to be relatively challenged. So I'm not a commodity. I don't see we're on the cusp of a big commodity boom as we were, say, when China first entered the WTO back in the early 2000s. We had a decade of a commodity boom. We were rolling in revenue at the time. I still think we're in a tech-driven global boom, which favours global markets over Australia. So we'll do okay, but probably a little bit less than what global markets are doing. Would be my outlook in terms of total returns. But as you said, if you want the beauty of our market is that the banks are relatively, almost like utilities in a way. They're very strong, sound companies with not great growth potential, but they're still churning out good income. Yeah. And there's many parts of our market like that. We're more, lower growth, but better income generating companies than say what you're seeing globally. So if you want that income and that dependability of income, then our market's still attractive.
That's right. It's a balancing act. I mean, if you want dividends and franking credits, then it's Australia. And if you go for the growth in the high P stocks, well, if interest rates are rising, then you're going to get volatility. So it's all about spreading it out. Yeah, and again,
so just on that, having said that, I mean, if interest rates do rise next year, technology generally tends to be one of those areas that doesn't do that well when rates are rising. So that may, funnily enough, it may be a period there where, if technology does underperform some of the value parts of the market, of which Australia have a good exposure, may do so. That in that period, Australia may actually do relatively better during the correction, if there is a correction, because that correction may well be led by the tech areas of the market.
Well, David, thank you very much for joining us.
No worries.
And to all you guys from Catapult Wealth, Merry Christmas. I hope you guys keep safe during this period.